SCHW stock. So Charles Schwab took a dive in 2023 as a result of concerns about its capital, liquidity, and trajectory of net interest income. The banking turmoil ignited by the collapse of Silicon Valley Bank focused the market's attention on the buildup of unrealized losses on fixed income securities and the related reduction in capital. The run on deposits on Silicon Valley also reminded investors of the liquidity risk of banking and loss of confidence that banks experienced in the global financial crisis. Even if Silicon Valley Bank hadn't failed, Charles Schwab and other depository institutions will still be undergoing a transition in their net interest income as cash sorting by clients, moving cash from low interest yielding accounts to higher yielding accounts and securities is decreasing interest earning asset balances, increasing funding costs, and pressuring net interest income. The folks at Morningstar believe all of these uncertainties related to Charles Schwab should be resolved soon, with interest rates peaking. Unrealized losses and cash sorting behavior may have already reached their zenith and should be trending down as cash inflows exceed deposit outflows. Charles Schwab will pay down high cost supplemental funding, and the weight on net interest income will lift. Finally, the company will build substantial capital over the next couple of years as it retains earnings and unrealized losses reverse. So they are increasing their fair value estimate for wide mode Charles Schwab to $80 from $70, as they have gained more comfort in the trajectory of the company's earnings after the effects of client cash sorting. At the end of the second quarter of this year, 2023, deposits from banking clients stood at $304 billion compared to a peak of $406 billion at the end of the first quarter of 2022. Clients have sorted their cash from low interest yielding swap deposits to higher yielding products such as money market funds. The outflows of deposits caused Charles Schwab to rely on higher cost funding sources such as certificates of deposits and federal home loan bank system loans to manage its balance sheet. The higher cost funding led to net interest income declines over the previous 2 years. After further analysis of prior periods of higher interest rates, historical Charles Schwab and TD Ameritrade client behavior, and recent data on market movement fund flows, they believe that Charles Schwab is turning the corner with its high cost supplemental funding needs that will boost net income and have greater comfort with the range for the company's long-term deposit balances. While the eventual cutting of interest rates by the Federal Reserve will bring with it another period of pressure on net interest income, they forecast multiple years of double-digit earnings growth after net interest income resets. So we have a couple of projections. We here on its chart. We have a downward projection of a further downward projection of $558.27 and 51.62, but upper projections, way more of them, a lot more of them. 60.6, 62.37, 63.48, 64.81, 66.36, 68.91, and all the way towards $75. All of these are quite modest relative to where it is right now. And let's see the weekly chart, what the projections are saying there on the weekly chart. Let's see weekly chart. We have I think on the weekly chart, I think there are way more downward projections. We have 58.71, 55.41, all the way down to 28.30. And then upper projections, we have 61.20, 65.8, 72.26, and then something around $90 or thereabout. So that's a lot more. It's a lot more ambitious on a weekly chart. So on the daily chart, once again, we have projections of all the way towards 534, but there is a broader market decay at the moment, and maybe not anytime soon. Maybe in the coming weeks we might see something from Charles Schwab. So see what you make of Charles Schwab, and I'll definitely continue to update you. Thank you very much for watching this video.